Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In this video, I'm going to give you an updated Nvidia stock analysis because Nvidia has been down a lot recently. I'm going to explain why I believe Nvidia stock is still substantially undervalued now. More importantly, I will explain why Nvidia will eventually recover and reach new highs again over the next several quarters. As always, I would like to give you more context first. At the time of making this video, the entire market, especially tech stocks, is experiencing a large correction. Most tech stocks have already dropped more than 20% from their recent peaks. The entire market has been down a lot because the market is concerned that Trump's tariffs and trade wars against other countries will lead to a recession, higher unemployment, and lower profits for many US companies. The market is concerned that Trump's tariffs will lead to higher inflation in the US. The US Fed is planning to hold high rates for longer to bring inflation back to the 2% target. As for Nvidia, the market is concerned that Trump's high tariffs on semiconductor chips manufactured outside the US and more AI chip export restrictions may lead to lower sales for Nvidia. Of course, Trump's tariffs and potentially more chip export restrictions will impact all the major tech companies including Apple, Broadcom, TSMC, AMD, and Qualcomm. In other words, Nvidia is not the only major tech company that is being impacted by Trump's tariffs and trade war. Just to give you more perspective, at the time of making this video, the Nasdaq 100 is already down more than 11% from its recent peak. This is as bad as the huge correction back in August last year. This means most tech stocks are oversold and greatly undervalued now. However, if we compare the current correction to the bear market during 2022 and early 2023, the current market correction is not as bad. The current market correction is self-inflicted. If Donald Trump hadn't started this trade war and threatened higher tariffs against Canada, Mexico, China, and the EU, the market as represented by the S&P 500 and Nasdaq 100 would not have overreacted and dropped this much. As for Nvidia, the important thing to understand is that Nvidia's business fundamentals, earnings growth, and long-term prospects in the AI data center market have not changed at all. I always say this, the best time to invest in an outstanding company is when the market is extremely favorable. So in this video, I'm going to explain why I believe Nvidia is substantially undervalued now. More importantly, I will explain why Nvidia stock will eventually recover and reach new highs again. I will talk about these topics in this video. When will the market recover from Trump's tariffs and trade war? Why Nvidia stock will eventually recover in the upcoming quarters, Nvidia stock valuation, and whether I plan to buy more Nvidia stock. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent investing analysis videos every week that will help you become a great investor. Each video usually takes me more than 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members become multi-millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing for the long term, follow my personal stock portfolios, and download the latest intrinsic valuation models for all the stocks I'm analyzing. So you'll know when a company becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Here is the most important question most investors care about now. When will the market recover? This is my best guess right now. I think there will be two scenarios. The best case scenario is that the market will recover by the second half of this year once Trump realizes that he has gone too far, threatening tariffs and starting a trade war against Canada, Mexico, China, and even the European Union. The worst case scenario is that the market will recover by next year once inflation comes down to the 2% target and once Trump starts easing some of his tariffs against other countries. Typically, during most market corrections and bear markets, it takes about 2 years for the market to recover. The US equity market as represented by the S&P 500 and the Nasdaq 100 will always recover and reach new highs in the long run because of the US strong economic growth, high GDP growth, rising corporate earnings, increasing productivity, continuous innovation, strong employment, a strong US dollar, and stable inflation. Now, as long as the US economy remains strong and continues to grow steadily, the market as a whole will always recover and reach new highs over time. This is why I believe it's important not to bet against the US economy. Realistically, the current market correction is not as bad as the bear market back in 2022. Here's why. During the 2022 bear market, inflation was exceptionally high. The Fed had to aggressively raise interest rates and implement restrictive monetary policies to slow the US economy and reduce inflation. Second, the current US inflation is much lower than before and is gradually approaching the 2% target. The US economy is stronger than before, and most S&P 500 companies are already earning higher revenues and profits than before. And third, the current market correction is essentially self-inflicted. Trump intentionally triggered this market correction to increase rallying for the US government through tariffs and reduce the national debt. Without Trump's trade war, the market would not have overreacted and corrected this much quickly. Here's an important question you should ask. Why is Trump creating so much uncertainty in the market? And why is he imposing tariffs and engaging in a trade war with other countries? Trump is imposing tariffs on Canada, Mexico, China, and even the EU because he wants to reduce the US trade deficit, increase government revenue to help pay off US debt, and encourage US companies to bring manufacturing back to the country, which will create more jobs for Americans, and protect US businesses from China's exceptionally cheap products and services. Trump insists that he wants to reduce the amount of fentanyl and the number of illegal immigrants that are coming to the US, but I do not think they're the real reasons he started this trade war. I believe reducing trade deficits, increasing revenue for the US government, and encouraging more US manufacturing are the main reasons he started this trade war. There's a bigger reason Trump started this trade war. Many investors do not know this. Trump publicly said that he wanted to decrease interest rates, but what he really meant was decreasing the long-term 10-year Treasury yield because the US government has a lot of debt to be refinanced within the next 12 months. Of course, the best way to reduce the 10-year Treasury yield is to create a lot of uncertainty in the market. This is why Trump started this trade war, imposing higher tariffs on other countries and making the market think that the US is heading into a recession. In other words, Trump is intentionally creating this market correction so the US government can refinance its debt at a lower rate than before. Earlier this year, the 10-year Treasury yield was as high as 4.8%. Recently, right before I started making this video, the 10-year Treasury yield dropped to as low as 4.2%. This means the US government can now refinance its debt at a much lower rate than before. You may wonder how much debt the US will need to refinance within the next 12 months. According to Google Gemini Deep Research, the US will likely have around 9.5 trillion of debt that is maturing within the next 12 months. This is a huge amount compared to the total national debt of 36 trillion in the US. No wonder Trump is intentionally causing the market to correct so that his government can refinance trillions of US debt at a much lower rate than before. Let's go back to Nvidia. I'm going to explain why I believe Nvidia will eventually recover in the upcoming months. As I mentioned earlier, the current correction is mainly because of Trump's tariffs and trade war. The important thing to understand is that Nvidia's business fundamentals, product roadmap, earnings growth, large economic moat, and long-term growth prospects in the AI data center market have not changed at all. Let me show you Nvidia's financials. These financials show that Nvidia's business is exceptionally strong. These financials show that Nvidia is still the best and most profitable semiconductor company in the world. Nvidia's revenue, operating income, free cash flow, and free cash flow margin have grown exponentially over the past 10 years. Of course, the biggest growth catalyst has been Nvidia's AI data center business. To be more specific, OpenAI's ChatGPT started the current AI revolution, or what I call the AI arms race. The current AI revolution is benefiting Nvidia the most because Nvidia has a near monopoly in the AI accelerator market. Nvidia's AI GPUs and AI systems are essential for developing frontier AI models and AI applications. Ever since ChatGPT came out in late 2022, almost all the major tech companies and AI labs around the world have been buying hundreds of thousands of AI GPUs and AI supercomputers from Nvidia every quarter. These AI labs, hyperscale cloud providers, and large tech companies need to build out their AI infrastructure so they can develop their frontier AI models and AI apps that have the potential to transform many industries. It's a matter of survival. They understand that they have to invest in AI infrastructure and frontier AI models now if they want to stay competitive in their industries. If they don't invest in AI infrastructure and AI applications now, they will be left behind. In terms of growth rates, Nvidia's value and EPS grew well over 100% each year over the past 2 years. Of course, these triple-digit growth rates are not sustainable, given that Nvidia is a much larger company than before. Nvidia's growth will likely slow down to more reasonable double-digit rates going forward. For example, Nvidia's total revenue already reached $130 billion last year. Its free cash flow already grew to $60.85 billion last year, which is exceptional. At the time of making this video, only Apple, Google, and Microsoft have a higher free cash flow than Nvidia. However, Nvidia still has the highest expected revenue growth rates over the next 2 years compared to the rest of the Magnificent 7 companies. According to this consensus forecast, Nvidia's total revenue is expected to increase by more than 50% this year. This expected growth rate is much higher than Apple, Google, Microsoft, Tesla, Meta, and Amazon's expected growth rates this year. This means Nvidia's free cash flow will likely grow to as much as $90 billion this year. This will make Nvidia's expected free cash flow almost as high as Apple's $98 billion free cash flow in 2024. Another thing we have to consider is that Nvidia's growth rates over the next 2 years are expected to be much higher than Apple's, so I wouldn't be surprised if Nvidia starts generating higher free cash flow than Apple by next year. I said this many times in my previous videos. The AI data center business, which includes AI compute and AI networking, will remain Nvidia's largest growth driver for many years. At the time of making this video, the AI data center market is already contributing more than 90% of Nvidia's total value. This means Nvidia is now mostly a data center company that makes the most advanced AI accelerators, large rack-scale AI systems, and AI software for data center customers and developers. So what are the growth catalysts that will benefit Nvidia's AI data center business the most going forward? First, we have to look at Nvidia's customer base. Who are Nvidia's biggest customers? Nvidia's biggest customers will continue to be the hyperscale cloud service providers such as Microsoft, Google, Amazon, and Oracle. In the most recent quarter, cloud service providers contributed about 50% of Nvidia's data center value. I believe they will continue buying a lot of AI systems from Nvidia every year because they need more AI compute for their internal AI workloads, such as developing their own AI models, as well as their external workloads, such as renting out their AI GPUs to customers or providing AI inferencing services to customers by hosting customers' LLMs on their servers. Second, Nvidia's AI systems, such as the current gen Blackwell and the next gen Rubin platform, are much more flexible and general than custom ASIC AI accelerators that are meant for very specific workloads. Based on one of Nvidia's AI systems such as Blackwell and next-gen Rubin are great for both training AI models and inferencing AI applications. The AI inferencing market will become much larger going forward because there will be many more use cases, such as agentic AI applications, enterprise AI applications, image and video generations, AI robotics, AI drug discovery, autonomous vehicles, personal AI assistants, and human-like conversational AIs like the movie Her. Also, as AI models become much more cost-efficient and cheaper to use, the demand for AIs and more capable AI models actually increases. This means the largest cloud providers, AI labs, consumer internet companies, and large enterprises will need to invest in more AI infrastructure going forward to support AI workloads and the large demand for AI. The biggest concern for Nvidia is whether AI spending will slow down going forward. I'm going to argue that AI spending will not slow down at all, at least over the next 2 to 3 years. Here's why. First of all, if you listen to the recent earnings call of Amazon, Microsoft, and Google, you will notice that all said the same thing. All of them stated that they don't have enough compute to meet customers' AI demand. If they had enough AI compute to rent out to customers and provide AI inferencing services, their cloud revenues would have been higher. This is why they plan to increase their AI capex and purchase more AI GPUs this year and likely next year. According to Yahoo Finance, these four hyperscalers, Microsoft, Google, Meta, and Amazon, had a total capex of $223 billion in 2024. This year, their combined capex is expected to grow to around $325 billion. This is around 46% higher than last year's combined capex. Of course, most of their combined capex will be spent on AI data centers. This means they will be spending a lot of money to buy Nvidia's Blackwell systems, the next-gen Blackwell Ultra systems, or even Nvidia's last-gen Hopper systems if they cannot buy Blackwell systems. The important thing to understand is that these hyperscalers will only increase their AI capex if they see strong demand for their AI cloud services. Their customers want them to have more AI capacity. They would not invest heavily in AI infrastructure if there were not sufficient demand for AI workloads. Let me give you another example. Right before I started making this video, Oracle, the fourth largest hyperscale cloud provider in the US, announced that they had a record remaining performance obligations or RPO of $130 billion in the recent Q3 quarter. Oracle added $48 billion to their bookings in one quarter. Based on what I know, this is the largest RPO increase in one quarter. The biggest growth driver is AI workloads, such as AI training and AI inferencing. Here's the important part you should know. This huge increase in RPO does not even include the upcoming Stargate AI project that will be run by OpenAI, SoftBank, and Oracle. I've said this in my previous videos. Sovereign AI will be one of the largest growth catalysts for Nvidia going forward. Major countries around the world are racing to build their AI infrastructure and advanced AI models that are tailored to their own cultures, language, and domestic data. Advanced semiconductors and AI are the new oil. It's essential that each country has its own AI infrastructure and advanced AIs for national security reasons and economic reasons. Earlier this year, OpenAI announced that it's partnering with SoftBank, Oracle, and MGX to build a Stargate AI infrastructure project. This project will cost up to $500 billion over the next 4 years. The purpose of this project is to ensure that the US will continue to be the dominant leader in AI capabilities and AI infrastructure. OpenAI and its partners will build AI data centers across the US. OpenAI will continue to develop the most advanced AI models, including AGI, to drive economic growth and increase the numbers of jobs in the US. This Stargate project will benefit Nvidia the most because a large percentage of this $500 billion investment will be invested in Nvidia's most advanced AI systems, such as Blackwell, Blackwell Ultra, and the upcoming Vera Rubin platform. Now, the EU and France have joined the AI arms race because they don't want to be left behind by the US and China. The EU and France have already announced that they will invest around $320 billion in AI infrastructure in the upcoming years. If you want to know Nvidia's expected growth rates over the next 2 to 3 years, one of the best ways is to keep track of TSMC's chip-on-wafer-on-substrate or CoWoS capacity expansion. According to this TrendForce industrial report, TSMC's monthly CoWoS capacity reached around 35,000 wafers by the end of 2024. By the end of 2025, TSMC's monthly CoWoS capacity is projected to reach 70,000 wafers per month. By the end of 2026, TSMC's CoWoS capacity is expected to grow further to 90,000 wafers per month. From 2022 to 2026, TSMC's CoWoS capacity is anticipated to grow at a compound annual growth rate (CAGR) of 50% and is expected to continue expanding through 2026. Around 60% to 70% of TSMC's CoWoS capacity is reserved for Nvidia's AI systems, such as the Blackwell systems. Typically, TSMC knows chip demand and the end market demand for AI workloads well ahead of the market. TSMC will only expand its CoWoS capacity if there's a strong demand for AI chips. This means Nvidia will likely report strong earnings this year as well as next year. The biggest growth drivers will be Nvidia's Blackwell systems in 2025, Rubin systems in 2026, and Rubin Ultra systems in 2027. I want to talk briefly about China's DeepSeek. I talked about this in my previous video. The market initially expected that cheaper and more efficient AI models such as DeepSeek would reduce the demand for Nvidia's AI GPUs. In reality, it's the opposite. More efficient and cost-effective AI models actually drive higher demand for Nvidia's AI GPUs because these efficient AI models allow more use cases and attract many more users. This is why the demand for Nvidia's H20 chips has increased a lot in China following the release of DeepSeek. Similar to other technologies such as personal computers, cloud computing, smartphones, and apps. As AI models become more efficient and cheaper to use, their adoption will increase, leading to a wider range of use cases. As AI models become increasingly capable, demand for AI will grow substantially. At the same time, as AIs become more cost-efficient, the return on AI investments will increase. Of course, when companies are earning higher ROIs, they will reinvest in AI infrastructure to develop even more advanced AI models. I believe this AI investment cycle will continue to grow for many years, as long as people keep finding new ways to use AI and its capabilities continue to advance over time. After consumer AI, the next biggest breakthrough will be agentic AI for large enterprises. This is my prediction based on my observation using AI apps almost every day. Very soon, we will have many AI agents that specialize in specific domains. These AI agents can help us complete tasks almost autonomously once we give them a command. The important thing is that these AI agents can help us save time and money and help us become much more productive. For example, if I want to research Amazon Web Services or AWS, I can ask Manus AI to help me analyze AWS and evaluate whether Amazon can potentially reach a 10 trillion market cap in the long run with supporting data and reasoning. Typically, researching a company or a business would take at least several hours to several days, but with an AI agent like Manus AI, I can prompt this AI agent to help me research AWS, go through all the available financial reports and latest articles about AWS, reason through all this data using long thinking or chain of thoughts, create an endless report, and turn this endless report into an interactive dashboard that is easier to understand. Typically, it will cost at least several $1,000s if I wanted to hire an analyst to analyze AWS and another developer to turn this report into an interactive dashboard. Within the next 10 years, we will see many companies releasing autonomous vehicles and humanoid bots. They are essentially AI agents that can interact with the physical world and help us do a task almost autonomously. All of them will need much more AI training, real-world simulation software, synthetic data for training, and AI hardware to train and run them in the physical world. Nvidia already has the AI hardware and AI software stack to train these physical AI agents. I will talk more about this in a separate video. Let me share the most important parts from Nvidia's recent earnings call. Nvidia's management talked about Nvidia's Blackwell ramp this year, the 3 AI scaling laws, and the company's long-term growth prospects in the enterprise market, agentic AI, and eventually physical AI, which includes autonomous vehicles and robots.
We are focused on expediting the manufacturing of Blackwell systems to meet strong customer demand as they race to build out Blackwell infrastructure. When fully ramped, we have many opportunities to improve the cost, and gross margin will improve and return to the mid-70s late this fiscal year.
There are now multiple scaling laws. There's the pre-training scaling law, and that's going to continue to scale because we have multimodality, we have data that came from reasoning that are now used to do pre-training. And then the second is post-training scaling law, using reinforcement learning human feedback, reinforcement learning AI feedback, reinforcement learning verifiable rewards. The amount of computation you use for post-training is actually higher than pre-training. And it's kind of sensible in the sense that you could, while you're using reinforcement learning, generate an enormous amount of synthetic data or synthetically generated tokens. AI models are basically generating tokens to train AI models. And that's post-training. And the third part, this is the part that you mentioned, is test time compute or reasoning, long thinking, inference scaling. They're all basically the same ideas. And there you have chain of thought, you have search. The amount of tokens generated, the amount of inference compute needed is already 100 times more than the one-shot examples and the one-shot capabilities of large language models in the beginning. And that's just the beginning. This is just the beginning. The idea that the next generation could have thousands times and even hopefully extremely thoughtful and simulation-based and search-based models that could be hundreds of thousands, millions of times more compute than today is in our future. We run every model. We are great at training. The vast majority of our compute today is actually inference. And Blackwell takes all of that to a new level. We designed Blackwell with the idea of reasoning models in mind. And when you look at training, it's many times more performant. But what's really amazing is for long thinking, test time scaling, reasoning AI models were tens of times faster, 25 times higher throughput. And so Blackwell is going to be incredible across the board. And when you have a data center that allows you to configure and use your data center based on, are you doing more pre-training now, post-training now, or scaling out your inference, our architecture is fungible and easy to use in all of those different ways. And so we're seeing, in fact, much, much more concentration of a unified architecture than ever before. Well, I'm more enthusiastic today than I was at CES. And the reason for that is because we've shipped a lot more since CES. We have some 350 plants manufacturing the 1.5 million components that go into each one of the Blackwell racks, Grace Blackwell racks. Yes, it's extremely complicated, and we successfully and incredibly ramped up Grace Blackwell, delivering some $11 billion in revenues last quarter. We're going to have to continue to scale as demand is quite high and customers are anxious and impatient to get their Blackwell systems. You've probably seen on the web a fair number of celebrations about Grace Blackwell systems coming online, and we have them, of course. We have a fairly large installation of Grace Blackwells for our own engineering and our own design teams and software teams. CoreWeave has now been quite public about the successful bring up of theirs. Microsoft has, of course, OpenAI has, and you're starting to see many come online. And so I think the answer to your question is nothing is easy about what we're doing, but we're doing great, and all of our partners are doing great. We know several things, Vivek. We have a fairly good line of sight of the amount of capital investment that data centers are building out towards. We know that going forward, the vast majority of software is going to be based on machine learning. And so accelerated computing and generative AI, reasoning AI, are going to be the type of architecture you want in your data center. We have, of course, forecasts and plans from our top partners. And we also know that there are many innovative, really exciting startups that are still coming online as new opportunities for developing the next breakthroughs in AI, whether it's agentic AIs, reasoning AIs, or physical AIs. The number of startups are still quite vibrant, and each one of them need a fair amount of computing infrastructure. And so I think the whether it's the near-term signals or the midterm signals, near-term signals, of course, are POs and forecasts and things like that. Midterm signals would be the level of infrastructure and CapEx scale out compared to previous years. And then the long-term signals has to do with the fact that we know fundamentally software has changed from hand coding that runs on CPUs to machine learning and AI-based software that runs on GPUs and accelerated computing systems. And so we have a fairly good sense that this is the future of software. And then maybe as you roll it out, another way to think about that is we've really only tapped consumer AI and search and some amount of consumer generative AI, advertising, recommenders, kind of the early days of software. The next wave's coming. Agentic AI for enterprise, physical AI for robotics, and sovereign AI as different regions build out their AI for their own ecosystems. And so each one of these are barely off the ground, and we can see them. We can see them because, obviously we're in the center of much of this development, and we can see great activity happening in all these different places, and these will happen. So near term, midterm, long term. And then the last thing that I would say is the software stack is incredibly hard. Building an ASIC is no different than what we do. We have to build a new architecture, and the ecosystem that sits on top of our architecture is 10 times more complex today than it was 2 years ago. And that's fairly obvious because the amount of software that the world is building on top of our architecture is growing exponentially, and AI is advancing very quickly. So bringing that whole ecosystem on top of multiple chips is hard. And so I would say that those 4 reasons, and then finally I will say this: just because the chip is designed doesn't mean it gets deployed. And you've seen this, over and over again. There are a lot of chips that gets built, but when the time comes, a business decision has to be made. And that business decision is about deploying a new engine, a new processor into a limited AI factory in size, in power, and in time. And our technology is not only more advanced, more performant, it has much better software capability, and very importantly, our ability to deploy is lightning fast. And so these things are not for the faint of heart, as everybody knows now. And so there's a lot of different reasons why we do well, why we win. And so almost everything that a consumer service provides, AI is at the core of it. Every student will use AI as a tutor. Healthcare services use AI. Financial services use AI. No fintech company will not use AI. Every fintech company will. Climate tech company uses AI. Mineral discovery now uses AI. The number of every higher education, every university uses AI. And so I think it is fairly safe to say that AI has gone mainstream and that it's being integrated into every application. And our hope is that of course the technology continues to advance safely and advance in a helpful way to society. And with that, we're I do believe that we're at the beginning of this new transition. And what I mean by that in the beginning is remember, behind us has been decades of data centers and decades of computers that have been built. And they've been built for a world of hand coding and general purpose computing and CPUs and so on and so forth. And going forward, I think it's fairly safe to say that world is going to be almost all software will be infused with AI. All software and all services will be ultimately based on machine learning, and the data flywheel is going to be part of improving software and services, and that the future computers will be accelerated. The future computers will be based on AI. And we're really at 2 years into that journey. And in modernizing computers that have taken decades to build out. And so I'm fairly sure that we're in the beginning of this new era. And then lastly, no technology has ever had the opportunity to address a larger part of the world's GDP than AI. No software tool ever has. And so this is now a software tool that can address a much larger part of the world's GDP, more than any time in history. And so the way we think about growth and the way we think about whether something is big or small has to be in the context of that. And when you take a step back and look at it from that perspective, we're really just in the beginnings.
Let me show you this consensus forecast from Seeking Alpha so you know NVIDIA's expected growth rates going forward. This year, NVIDIA's revenue is expected to grow by around 57%. Next year, NVIDIA's revenue is expected to grow by around 23%. After that, NVIDIA's revenue growth is expected to decelerate more. As I mentioned earlier, NVIDIA's Blackwell, Rubin, and Rubin Ultra platforms will be NVIDIA's largest growth drivers over the next 3 years. In terms of EPS forecast, NVIDIA's EPS is expected to grow by around 51% this year. Next year, NVIDIA's EPS is expected to grow by around 28%. After that, NVIDIA's EPS growth is expected to decelerate more. Let's look at NVIDIA's valuation. At the time of making this video, I believe this forward PE suggests that NVIDIA is still greatly undervalued. For example, NVIDIA's forward PE is expected to be around 27. This is exceptionally low for a mega-cap tech company that is expected to grow by around 50% this year. Next year, NVIDIA's forward PE is expected to be around 21. Again, this is too low for NVIDIA when its EPS is expected to grow by around 28% next year. In fact, NVIDIA's forward PEs are much lower than Palantir's and Tesla's, even though NVIDIA's growth rates are expected to be much higher over the next 2 years. Right now, I'm developing this investing app with a friend. This is a preview. This investing app will be out this year. The orange line is NVIDIA's fair value over time. The blue line is NVIDIA's share price, and these two dotted lines are price targets. According to our investing app's calculation, NVIDIA is still well below its fair value. We believe NVIDIA's fair value should be around $150 per share. The analyst's average price target is around $173 per share, and our price target is around $170 per share. This means NVIDIA is likely greatly undervalued and has a good margin of safety now. I've been dollar cost averaging and buying more NVIDIA shares during this large dip recently. I also calculated NVIDIA's intrinsic value using this intrinsic valuation model. This intrinsic valuation model tells me when a stock is likely undervalued, fairly valued, or overvalued. If you want this intrinsic valuation model, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define NVIDIA's intrinsic value as its future free cash flows discounted to the present day. I use a discount rate of 10.5% here. You can use a higher discount rate here if you want to be more conservative. Based on the expected growth rates and the long-term growth prospects I talked about earlier, I believe NVIDIA's revenue will grow between 50% and 55% this year. After that, I believe NVIDIA's revenue will grow at a compound annual growth rate or CAGR between 10% and 15% over the next several years. I use a long-term growth rate of 7.5% to calculate the terminal value. If you want to be more conservative, you can use a lower long-term growth rate to calculate the terminal value. Over the next several years, I'm assuming NVIDIA's free cash flow margin will decrease slightly because of increasing competition from Broadcom's custom ASIC AI accelerators and AMD's AI accelerators. Let's go over these 3 case scenarios: worst case, normal case, and best case scenarios. Under the worst case scenario, we forecast that NVIDIA's revenue will grow by around 50% this year. After that, we forecast NVIDIA's revenue will grow at a CAGR of 10% each year over the next several years. Then NVIDIA's intrinsic value should be around $3 trillion for the entire company, or $122 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we forecast that NVIDIA's revenue will grow by around 52.5% this year. After that, we forecast NVIDIA's revenue will grow at a CAGR of 12.5% each year over the next several years. then Nvidia's intrinsic value should be around 3.3 trillion for the entire company, or $135 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we forecast that Nvidia's revenue will grow by around 55% this year. After that, we forecast Nvidia's revenue will grow at a CAGR of 15% each year over the next several years. Then Nvidia's intrinsic value should be around 3.67 trillion for the entire company, or $149 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Nvidia's intrinsic value should be around $135 per share. I also use a forward sales valuation model to estimate Nvidia's intrinsic value, which should be around 3.9 trillion for the entire company, or around $159 per share. If we calculate the average of both valuation models, I believe Nvidia's intrinsic value should be around $147 per share. Just to compare, Morningstar has given Nvidia a lower fair value of $130 per share. This means I believe Nvidia is still greatly undervalued now. So will I buy Nvidia stock? Yes, I will continue buying more Nvidia shares over time because I believe it will continue dominating the AI data center market for years to come. Nvidia is one of my largest positions. I plan to keep investing in Nvidia whenever it's well below its intrinsic value. This is one of my counts. I took the gains and proceeds from selling Apple and Tesla shares last year. Then I have been dollar cost averaging and adding to my Nvidia position over the past year whenever it was undervalued. Based on the intrinsic valuation calculation I showed earlier, I believe Nvidia is currently greatly undervalued. This is my prediction. The demand for AI will continue to grow as AI models become increasingly capable and cost efficient. Like any other software, as AI becomes more affordable, adoption will increase. This leads to a broader range of use cases. Greater cost efficiency will also drive higher returns on investment (ROI) over time. The biggest growth drivers for Nvidia will be agentic AI for enterprises, physical AI such as humanoid robots and autonomous vehicles, and eventually artificial general intelligence or AGI. The AI inferencing market will become the largest growing market going forward. This is why I believe AI spending and the demand for Nvidia's AI systems will continue to increase over time. Now, all these are only my opinions and my analysis that's based on my research. They are not financial wise. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.